Let me be brutally honest with you for a moment. If you have any financial interest in Vietnam, whether it's an investment, a business, or you're simply holding Vietnamese dong, what you're about to hear cannot be ignored. The whispers have turned into a decisive roar, and the State Bank of Vietnam is not just considering reform, they are actively executing a comprehensive, multi-pronged strategy to fundamentally reshape the dong's value and stability. And this isn't happening in a vacuum. It's a direct, calculated response to a perfect storm of internal economic pressures that have reached a boiling point. For months, the official exchange rate between the dong and the US dollar has been held within a tight band through sheer intervention. But behind that stable facade, the parallel market was screaming a different story. With a premium so wide it exposed a deep-seated lack of confidence and a dangerous dollarization of the economy. The central bank's foreign reserves, while bolstered by recent trade surpluses, have been bleeding to defend the currency, creating an unsustainable cycle where every dollar spent on stabilization was a dollar not spent on critical long-term development projects. But the real catalyst, the unignorable fire alarm, has been the seismic tremors emanating from Vietnam's own corporate bond and real estate sectors. You see, over the past decade, a massive credit bubble inflated, fueled by cheap dong and a ferocious appetite for real estate development. Giant conglomerates like Van Thien, Phat, and Tan Hoang Minh became household names, leveraging complex bond issuances to fund sprawling projects. But when the global tide of easy money receded and interest rates soared, the music stopped abruptly. The subsequent arrests of high-profile tycoons like Truong My Lan, accused of orchestrating a staggering $12.5 billion fraud, didn't just cause a scandal. It detonated a trust bomb within the entire financial system. Suddenly, the corporate bond market, a key source of capital, froze solid. Investors were left holding worthless paper, real estate projects from Hanoi to Ho Chi Minh City ground to a halt, and a wave of maturing bonds threatened to trigger a cascading default across the banking sector. This is the core vulnerability the state bank is now desperately trying to surgically address. A weak dong in this context is not merely an export advantage, it is an existential threat. It makes servicing the colossal dollar-denominated debt taken on by these very corporations astronomically more expensive, pushing them closer to the brink and directly imperiling the banks that lent to them. Therefore, this dong reform is not a proactive move for glory. It is a defensive, imperative operation to save the entire banking system from a contagion event. They are attempting to thread a needle blindfolded in a hurricane. They must allow for a managed, gradual adjustment of the dong's value to reflect economic realities without triggering a panic-driven stampede out of the currency. So when you hear the term currency reform, you must look beyond the dry headlines of exchange rate bans and intervention. They must restore confidence so that domestic capital stops fleeing to dollars and starts flowing back into the system. And they must do all of this while navigating the treacherous waters of global monetary policy, where a resilient U.S. economy and a still hawkish Federal Reserve offer attractive yields, pulling capital away from emerging markets like Vietnam. You are witnessing the central bank's last best weapon in a larger war to contain a domestic financial crisis that has been simmering for years, a crisis born from a toxic blend of exuberant, over-leveraged corporate governance failures and a global macroeconomic shift. The stability of the dong is now inextricably linked to the stability of Vietnam's banks and the survival of its largest corporations. The activation of this reform package is a clear signal that the authorities believe the internal risk of a banking collapse now outweighs the external risk of a slightly weaker currency. They are choosing their poison, and the entire financial future of one of Asia's most promising economies hinges on getting this delicate balance exactly right. This is far more than a currency update. It is a live broadcast of an economic triage procedure. So, if the domestic financial crisis is the unyielding pressure forcing the State Bank of Vietnam's hand, then the real question becomes, what are the actual tangible levers they are pulling in this high-stakes operation, and how do they intend to navigate the treacherous path between devaluation and disaster? The term currency reform can sound abstract, but in practice, it's a precise and brutal surgical toolkit, and the Vietnamese authorities are deploying it with a focus that reveals their acute understanding of the vulnerabilities we just discussed. The first and most visible instrument is a strategic, managed devaluation of the dong's reference rate, a move that is as much about economic realism as it is about psychological warfare against the black market. By allowing the official rate to gradually weaken in a controlled manner, The central bank is effectively pulling the rug out from under the speculators who have been thriving on the wide gap between the official and parallel rates. They are acknowledging the market's pressure, but dictating the terms of the adjustment, thereby reclaiming control of the narrative and preventing a disorderly, panic-fueled collapse. But this is merely the public-facing tip of a much deeper iceberg. The true battle is being fought on the front of interest rates and systemic liquidity. You will have noticed a series of subtle but decisive hikes in key policy rates, such as the refinancing and discount rates, which may seem counterintuitive when trying to stimulate a slowing economy, but this is a calculated move to make holding Vietnamese dong more attractive. By raising the yield on dong-denominated assets, the state bank is attempting to create a compelling interest rate differential that discourages the mass conversion of dong into US dollars, a practice that had become a national pastime for both corporations and individuals seeking a safe haven. This is a direct assault on the dollarization of the economy, aiming to reverse the capital flight that has been draining foreign reserves and undermining monetary sovereignty. However, this high interest rate medicine comes with a severe side effect. It tightens credit conditions domestically, making it even more expensive for those already struggling real estate developers and corporations to refinance their existing debt, potentially accelerating the very defaults the reform is meant to prevent. This is the central bank's calculated gamble, that the short-term pain of a credit crunch is a necessary price to pay for long-term currency stability and the prevention of a full-blown banking crisis. Simultaneously, they are waging a war on the foreign exchange black market itself, with the State Bank of Vietnam publicly committing to increase the supply of US dollars through commercial banks and launching intense inspection campaigns targeting gold shops and illegal currency exchanges in hotspots like Hanoi's Ha Trung district and Ho Chi Minh City's Jewelry Street. This isn't just about enforcement, it's about sentiment. Every illegal exchange shut down, and every public announcement about dollar supply is a message aimed at breaking the speculative fever and convincing the public that the official banking channel is the only legitimate and reliable source for foreign currency. Furthermore, they are aggressively pushing for increased use of non-cash payments and tightening regulations on cash transactions, particularly in the real estate sector, which has traditionally been a bastion of large, under-the-table dollar deals. This forces more economic activity into the formal, transparent banking system, where it can be monitored, taxed, and crucially kept within the dong ecosystem. All of these tools, the managed devaluation, the interest rate hikes, the crackdown on the parallel market, and the push for financial digitization, are interconnected threads in a single overarching strategy to restore faith in the Vietnamese dong as a reliable store of value. They are trying to convince a skeptical population and a nervous business community that it is safer to keep their wealth in dong, earning a higher interest rate than to squirrel it away in greenbacks under the mattress or in an illegal gold shop. The ultimate goal is to break the vicious cycle where a weak dong causes capital flight, which in turn weakens the dong further. They are attempting to initiate a virtuous cycle, a stable, or at least predictably managed. Dong encourages capital to stay, which strengthens the currency's fundamentals, which in turn builds more confidence. It is an immensely delicate and risky balancing act, one that requires not just technical precision, but also a masterful command of market psychology. The State Bank of Vietnam is not just moving numbers on a screen. It is trying to rewire the deeply ingrained financial instincts of an entire nation. And the success of this entire reform package hinges entirely on whether they can win that battle of belief before the short-term economic pain becomes politically and socially unbearable. Now, while the State Bank of Vietnam is fighting this brutal domestic war for monetary stability, it is absolutely critical to understand that they are not fighting it on an isolated battlefield. The entire global economic arena is watching, and the ripple effects of this reform, whether it succeeds or fails, will extend far beyond Vietnam's borders, fundamentally reshaping its relationships with trading partners, foreign investors, and international financial institutions. The immediate and most obvious impact is on Vietnam's staggering export machine, which has become the lifeblood of its economic miracle, flooding the world with everything from Samsung smartphones and Nike sneakers to seafood and textiles. A strategically weaker dong, a likely outcome of this managed float, makes these goods cheaper and more competitive on the global market, potentially boosting export volumes at a time when global demand is softening due to recessions in Europe and a cautious consumer in the United States. This provides a crucial cushion for the Vietnamese economy, helping to maintain GDP growth and protect jobs, even as the domestic financial sector undergoes this painful corrective surgery. However, this perceived currency advantage is a double-edged sword that will not go unnoticed in Washington, D.C., Brussels, or Tokyo. The United States Treasury in particular has kept a watchful eye on Vietnam's currency practices for years, and a deliberate devaluation, however justified by domestic necessities, runs the very real risk of landing Vietnam back on the list of currency manipulators, a label that could trigger punitive tariffs and strain the crucial trade relationship that has been a cornerstone of Vietnam's rise. This is the tightrope the government must walk, using the currency as a tool for internal stability without provoking a protectionist backlash from its most important export markets. Simultaneously, the reform sends a powerful, albeit conflicting, signal to the foreign direct investment community that has poured billions into Vietnamese manufacturing. On one hand, a stable and predictable exchange rate regime, which is the ultimate goal of this reform, is manna from heaven for multinational corporations like Intel, LG, and Foxconn, who are making long-term bets on the country and need to repatriate profits back to their home countries without being decimated by wild currency swings. The demonstration of a competent and proactive central bank can enhance Vietnam's credibility as a safe harbor in a shaky global economy. But on the other hand, the very reasons for the reform, the exposed corporate corruption, the fragile banking sector, the real estate bubble, serve as a stark warning about the underlying governance risks and the potential for unforeseen political or economic shocks. Sophisticated investors will now be scrutinizing Vietnam not just for its low labor costs and strategic location, but for the depth of its financial markets, the true health of its banking system, and the government's ability to manage a complex crisis without resorting to capital controls or other drastic measures that could trap their investments. Furthermore, the success of this entire endeavor is inextricably linked to the path of the U.S. Federal Reserve. If the Fed remains hawkish and keeps U.S. interest rates high, the gravitational pull on global capital will continue, making it exponentially more difficult for the State Bank of Vietnam to defend the dong and maintain its interest rate differential. Every speech by Jerome Powell is now a direct input into the monetary policy calculations in Hanoi. The final outcome, therefore, is not a foregone conclusion. We are looking at a spectrum of possibilities. From a best-case scenario where the reforms successfully anchor inflation, restore confidence, and attract a new wave of high-quality investment, cementing Vietnam's status as the next Asian tiger, to a worst-case scenario where the measures prove insufficient. Confidence evaporates, capital flight accelerates, and the central bank is forced to burn through its reserves and impose harsh capital controls, severely damaging its international reputation for years to come. The path they are on is the only one available, but it's fraught with both immense opportunity and existential peril. This is why you cannot afford to be a passive observer. This isn't just a news story, it's a live case study in economic transformation with real consequences for your financial decisions.